Assalamu alaikum everyone. My name is Ismail Hossain Sami. My role ID is 231043734. Today I will explain overview of the latest monetary policy of Bangladesh Bank. So here is the slides and then we go to the next slide. A table of contents. Here we explain introduction, summary of the monetary policy, significant change compared to the previous policy, tools used by Bangladesh Bank, suggested policy reforms, and at last conclusions. Here are the introductions. At first we explain what is monetary policy. Monetary policy is a process by which a country's central bank, for example Bangladesh Bank, controls the money supply, interest rate and credit availability in the economy. Our second slide is summary of the latest monetary policy, July to December 2025. Objective of the monetary policies. Here first, Bangladesh Bank maintains a tight monetary policy stance of H1 FY26. The policy repo rates unchanged 10% until inflation falls below their hold about 7%. The standing lending facilities SLF rates remain 11.5%. The standing deposit facilities SDF rate is 8%. The standing lending facility SLF rate remains at 11.5% and the standing deposits facilities rate is 8%. The exchange rate has been moved toward a more flexible market-based system as a part of efforts to stabilize the taka and rebuild foreign reserves. The information's target for full FY26 is contained inflations at or near 6.5%, though actual inflation remains higher. Bangladesh Bank emphasized the needs to rebuild foreign reserves, maintain external balance, and strengthen governance and supervision in banking sector, especially in light of elevated and non-performing loans. Here are the objectives of monetary policy. Our next is changing compared to previous policies. Here are the changes. The credit growth target of the private sector has been lowered significant from 9.8% to 7.2%, reflecting tight liquidity and desire to moderate overheating. Bangladesh Bank has emphasized move to full flexible exchange rate regime or more market-based to allow smoother adjustment and bolster external resilience. While earlier focuses has been made on managing board money supplies, reserves, the current policies place stronger emphasis on governance reform, banking sector supervision including risk-based supervision. The holds of the possible policy rates reduction is clearly started. Inflations must be dropped below 7%. This slightly the Bangladesh Bank has yet ready to erase until inflation is under better control. The stance remains contradictory, tight as opposite to earlier, erasing the neutral stance in the some periods when inflation was lower. Thus, the policy shifted is toward more caution, monitoring credit growth, maintenance, higher rates, greater exchange rate flexibility, and strong banking supervision. Here are the comparison with last MPS H1 FY25 versus H1 FY26 FX resume in fiscal year 25 managed and fiscal year 26 fully flexibles, inflation risings, and here is the inflation decline after the interim governments came. Repo rates increase is steady at 10%, CRR 3.5%, and in fiscal year 25 and in fiscal year 26 3.0%, where 3.0% is better. NPL policy is monitoring in fiscal year 25 and after next fiscal year 26 strong constructural actions. Reserve. H2 is falling and H1 is recovering. Policy focus, crisis control, stabilizations and reforms. What are the tools that Bangladesh Bank use to control? Here is the repo and reverse repo rate, CRSLR, open market operations, FX market operation, interest rate corridor, moral situations and regulatory guidance, liquidity support facilities, credit controls, and prudential tools. Suggested policies from reforms. Here is I think so that improves in those markets, improves monetary policy transmission, strengthen NPL management, deepen financial markets, promote digital finance, enhance governance and coordinations, flexible monetary framework. After that, we can conclusion the latest monetary policy of Bangladesh Bank for the first half of FY26, fiscal year 26, is characterized by the caution's tight stance aimed at reining in inflation, stabilizing in exchange rate, rebuilding external buffers, and strengthening financial stability. Thank you everyone. Hope you will enjoy the lesson.